Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Wednesday, the 8th of January 2025. So before we jump straight into our gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term intraday technical outlook on those broad-based cross-asset classes that we cover on a daily basis, we have a quick recap of what has taken shape yesterday in terms of the news flow, relevant economic data release, and their impact towards the intraday performance of the broad-based cross-asset classes. So let us start with a key US economic data release first, which is the all-important ISM services ISM services PMI. Pardon me, I repeat again, ISM services PMI. Why is it important? It's considered as one of the leading key economic US indicator, indicating the health of the US economy. Why? Because we know that close to 2/3 of US economic growth in the past 20 years or so has been pretty much driven by the services activities in the US, where this services PMI is being used to gauge the health of the services or the state of the services activity in the US. So the headline services PMI data, which is over here, if you see my screen, rose up slightly above expectation. Oh, pardon me, I still have that sore throat. At 54.1, above 53.3. There was a market that's expecting, and also above 52.1 in the previous month of November. So if you look at the trend of the services PMI, so what we could see over here is a rather resilient services activities condition in the US economy over here. So if you look at the 3-year trend, it's still inching upwards over here at this point in time. So represent a kind of a Goldilocks US state of the economy. That means the US is no clear sign or near-term sign that it has slipped into a recession. That means economic growth is still strong for the US economy. But however, if you look at the sub-component over here, which is the services prices. So we know that services PMI, there are various sub-components. So the services prices is considered as cost of doing business in the services industry in the US. Put it this way. So for services prices paid, it actually rose rather steeply from the month of December, 64.4 above 57.5, and also 57.5 is what market is expecting, and above 58.2, that is the previous month of November print. So if you look at the trend of the services prices paid, very clearly it seems to be doing a kind of a bottoming formation. Previously, since the post-pandemic is in a deceleration mode, and after decelerating, it formed a kind of a base in March this year and start to see a series of higher high and higher low, and looking to do this bullish breakout of January print of 64. So yesterday print of December print of 64.4 for services prices paid is almost the highest level in almost a year. So what it means that the cost of doing business in the services industry has increased. That means, i.e., it represents inflationary pressure is not residing in US, but is showing signs of picking up. All right, and that could potentially be amplified if Trump were to actually follow through with his rather hawkish international trade policy, where yesterday there's a news flow that he actually escalate trade against Canada again, Greenland, and Panama. All right, so potentially it seems to us that Trump is trying to gain some concessions from this country, US major trading partner, especially Canada, if he were to actually follow through his so-called tariffs, we call it hawkish tariffs policy, that could for sure amplify inflationary pressure into the US economy, and that has been pretty much responded by a rising longer term US 10-year treasury yield. So think about it as the 10-year treasury yield as a long-term interest rate. So we know that if inflation pressure were to go up, the 10-year US Treasury yield will also face upside pressure as well. So for those who followed my daily dose of market insight, I've been stressing that this is one of the key intermarket dynamics that we should pay attention to. Why? Because it represents longer term interest rate. All right. So if this longer term interest rate has a direct correlation with longer term inflationary expectation or inflationary pressure. So we know that just now I shared with you all the ISM services prices paid has rose to close to a year high, potentially inserting inflation pressure in the US economy, coupled with Trump rather persistent hawkish international trade policy towards its trading partners. That means, i.e., enacting trade tariffs or threatening with trade tariffs, hoping to gain consensus from these major trading partners that they got to pay some due to the US. Net overall, the market responded with a push up in the US 10-year Treasury yield. So this US 10-year Treasury managed to stage a bullish reversal right exactly at the 20-day moving average, also the near-term support level of 4.49%, and now en route to a key major resistance at 5% and 5.2%. And with this push up in the US 10-year Treasury yield, that also saw a rebound in the US dollar index as well. So recall yesterday we flipped to a bullish bias, looking for dollar strength to come back in the euro against the sterling, the Aussie, and remain bullish on the dollar yen. That actually plays out as expected for those who follow my daily dose on a frequent basis. So we know that daily on the intraday technical outlook, those are good for intraday price levels. So I urge you all to actually listen every day on the daily dose, because those levels are being refreshed daily today. All right, so later I'll showcase what are the key levels to watch out for today again on those dollar major pair, and as well as other broad-based cross asset classes once we covered into the intraday technical outlook segment. So nice bullish reversal right exactly at the 20-day moving average as well, and also the lower boundary of this green channel here, which is the medium term ascending channel since the low of 30th of September. So what you could see, the dollar index over here is medium term and short term bullish trend remains intact. Whatever the last 2 days of dollar setback story from starting from last Friday all the way up to Monday, more or less has been over, and right now is shaping its impulsive up move sequence, looking up for the next intermediate medium term resistance to come in at 110 111 figure level, which is the upper boundary of this medium term ascending channel, and also the swing high area of 9th of November 2022. And also what's interesting over here is that we know that US 10-year Treasury yield also represents longer term interest rate. So longer term interest rate also tends to see impact the bank's borrowing interest rate costs as well. So we know that the US 10-year Treasury yield is being used as a kind of a risk-free rate. So your housing loan, your corporate loan is being used to price off by using the 10-year US Treasury yield as a benchmark. So if this longer term risk-free rate going to push up on the upside higher and higher, that means the cost of doing business in terms of interest rate costs when they reset over here also rises as well. So that could actually eat into net profit margins of corporation, and that has been responded by the major US stock indices yesterday. So still recall that despite Nasdaq 100 outperform on Tuesday, we were rather less reluctant to have a bullish bias on an intraday basis, and we actually flip to a neutrality stance. So that plays out as expected, because we do see still some form of technical weakness in the Nasdaq 100. So later I'll touch on more later when we cover the intraday technical outlook. But because of this rising 10-year US Treasury yield, implying potential future interest rate costs will start to increase for globally, and that could potentially eat into the net profit or earnings in US corporation, and causes a negative feedback loop yesterday on the major US stock indices, 4 of them. So all 4 of them closed in the red. The worst performer was the Nasdaq 100 because being a higher beta in nature compared to the other three major US indices. So the Nasdaq was down by negative 1.8%, the SPX down negative 1.1%, the Dow Jones negative 0.4%, and the Russell 2000 up 0.7%. And one of the reasons why the Dow Jones fares slightly worse is because of there are several financial stocks like JP Morgan, Goldman Sachs has a higher weightage in the Dow Jones Industrial Average, where they actually outperformed yesterday. Right, so the banks actually outperform. The big banks actually outperform. JP Morgan is up by almost 1%. Bank of America up 1.5%, and Citibank is up 1.3%. So that actually also benefited from a rising, we call it US Treasury yield curve, as the 10-year US Treasury yield rose at a faster rate than the 2-year. Right, so that could actually improve the bank's net interest margin ratio. So we know that banks tends to actually lend up long term, so that's their interest income, and borrow short term. Because of the interest rate on the higher tenure starts to rise faster, that means banks revenue book from corporate loans also starts to increase as well. So that actually represent the outperformance of this major bank yesterday, putting we call it less damage to the Dow Jones Industrial Average yesterday. Right, over here. Okay, so yes, so and also earlier this morning we do have Australia monthly CPI data that is out as well. Over here, the monthly CPI data. So it rose slightly above expectation at 2 point, as market is expecting 2.2%. It came from the month of November, it came in at 2.3%. So that actually also see the dollar, the Aussie dollar rebounding a fair bit. So if you look at the intraday the 5-day rolling performance of the US dollar against the other major currency, it starts to pick up yesterday. And what you see over here is that the dollar Aussie starts to slip slightly in today's Asia session. But however, the short-term bearish dynamic of the Aussie dollar is still intact. Later I'll explain more when I cover the Aussie dollar in my intraday technical outlook segment. Okay, from there. So yeah, that's actually sum up the yesterday's intraday performance on the respective broad-based cross asset classes on share with you all, and how this movement is being impacted by yesterday's release of key economic data and relevant news flow. So before we jump straight into the intraday technical outlook, there's one particular intermarket dynamics on share view that could have an impact on the FX market, and as well as the so-called the major US stock indices. Is this all important inflationary expectation, which is the dark blue line and the light blue line, US 5-year break-even inflation and US 10-year break-even inflation. Okay, so what is this break-even inflation? So this break-even inflation, think about it as 5-year inflation expectation 5 years from today, and inflation expectation 10 years from today. So this is what market is expecting future inflation trend will be in the US economy, taken up from market transacted prices from the US Treasury protected securities from here. So this in a nutshell. So what you could see over here is that since the start of the current US Federal Reserve interest rate cut cycle on the on September last year, the US Fed is still in a interest rate cut cycle, but except that in the latest FOMC meeting in December, they expressed a less dovish stance. That means for 2025, there could be a much shallower interest rate cut, potentially only 2 to 1 interest rate cut. And there's a big risk over here is that if this 5 and 10-year break-even inflation going to rise higher and higher. So if you look at it over here, let me put it in a way. So let me hide the rest of it. Okay, let's see. Let me hide it. Let me hide it. Okay, you notice that it's now attempting to shape a bullish breakout from the resistance over here, both the 5-year and the 10-year. Okay, there's this resistance line here at around 2.5%. Okay, 2.5%. So if it starts to shape a bullish breakout from 2.5%, so what it means that market is now pricing in higher inflationary pressure in the US 5 years from now and 10 years from now. And we know that what mark the Fed want is that the Fed wants longer term inflation to remains at around the 2% level. So if this 5-year break even and 10-year break even rate starts to break out above 2.5%, and that could potentially see further upside on the northwards, that means it starts to live further and further away from the 2% long-term inflation target that the Fed desired. So once that happened, you will start to see the 10-year US Treasury yield going up as well. And you realize that why? Since the start of the US Federal Reserve interest rate cut cycle in September last year, the 10-year US Treasury yield has been moving in a very strong direct correlation with the 5-year and 10-year US break-even inflation. That means, i.e., if a breakout of 2.5% for both the 5-year and the 10-year US break-even inflation, implying that inflation expectation in US starts to go northwards, that could add further upside pressure on the US 10-year Treasury yield, heading towards 5.25% and maybe beyond that. And that could actually see further dollar strength as well. And that could also indirectly cause a negative feedback loop into the major US stock indices, spreading towards the rest of the world. All right, if this is being left unchecked. All right, there's some implication that I want to share with you guys right over here. So let me put it back again. I think that's okay, great. So this is the intermarket dynamics I want to share with you all, more from a medium term to longer term perspective, that it could impact on the US dollar, and as well as the creating a potential negative feedback loop into the major US stock indices from a medium term perspective. All right, so with that, let me now expand my screen so that we could focus now on the intraday technical outlook segment, so that you guys can have a better view on the key levels that I'm going to share with you in a couple of seconds time. So without further ado, let's kickstart the intraday technical outlook on the FX market first over here, starting with the euro dollar. So the euro dollar right exactly did a retest again during the European session first, which is the 20-day moving average, then thereafter shape a bearish reaction as expected. All right, so those who followed my daily dose, we have already been flipped to a bearish bias on the euro dollar, stating that from Friday low all the way up to Monday's high, this mean reversion rebound is more or less ended. So first support level to watch will be at 1.04. First resistance level to watch, pardon me, I repeat again for the euro dollar. First resistance level to watch will be 1.0420, because it hasn't broken down below the first support level that we have yesterday for our intraday bearish bias at 1.033. We do not want to tighten our short-term pivotal resistance to be at 1.0420, still using 1.0460 as my short-term pivotal resistance level, still maintaining that intraday trend bearish bias on the euro dollar. A breakdown below 1.0330 for today may expose the next near-term support level at 1.025. Okay, 1.0250, which is the minor swing low area of 3rd of January, last Friday. Only a push up and an hourly close above this 1.0460 level will invalidate today's intraday bearish bias to see a squeeze up or the continuation of the extension of the mean reversion rebound scenario unfolding, exposing the next near-term resistance levels at 1.0510, followed by 1.0540 next, which is the minor swing high area of 11th of December, 17th of December, and also confluencing with this downward sloping 50-day moving average as well. So that's for the euro dollar, still maintaining a intraday trend bearish bias using 1.0460 as my short-term pivotal resistance for today. What's next for the sterling dollar? Its cousin. So the sterling dollar also continues to plummet, but hasn't break below our first support level that we highlighted yesterday in our trend bearish bias scenario for yesterday at 1.2460. Given that it hasn't break below 1.2460, I don't want to type my pivotal resistance to be so tight. So still maintaining at the 1.26 figure level, which is the close to the downward sloping 20-day moving average, and as well close to the upper boundary of this medium-term descending channel that is still in place since the high of 27th of September last year. So no change, still maintaining the intraday trend bearish bias for the sterling dollar using 1.26 figure level as my short-term pivotal resistance level. A breakdown below 1.2460 today exposes 1.2350 next. However, if price action starts to push up with an hourly close above 1.26 figure level, that would invalidate today's intraday bearish bias to see a squeeze up or the extension of this mean reversion rebound scenario, exposing the next near-term resistance level at 1.2670 followed by 1.2620, which confluence with the downward sloping 50-day moving average as well. All right, so net in a nutshell, still maintain that intraday trend bearish bias on the sterling dollar using 1.26 figure level as my short-term pivotal resistance. All right, so now back to the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar also floated down as expected, and right now it managed to actually stop over here due to the much more slightly higher than expected monthly Australia CPI data, which I covered earlier on. So right now the RSI also starts to bounce off from close to the oversold region, so there could be some signs of rebound heading into the European session thereafter. So I will use this rebound to fit any strength and maintain that intraday bearish bias. So first resistance level to watch over here could be the 0.6260 level. Okay, 0.6260 level over here. So this 0.6262 level, if you go to the Fibo retracement, okay, from this sell-off that has taken shape in the late European session all the way down to today's Asia session intraday low, that also correspond to the golden ratio of 61.8% as well, right? So this will be the first resistance level to watch. Also, there may be some form of residual, so I do not want to push it at 62.60 as my short-term pivotal resistance level. I'll be using 63 figure 63.20 level, all right, which is also the upper boundary of this medium-term descending channel that I drew from the swing high of 30th of September last year. So net overall, tidying up a bit of the short-term pivotal resistance for today, looking to actually fit any strength to maintain that intraday bearish bias on the Aussie dollar using 63 figure 63.20 as my short-term pivotal resistance zone for today. First support level to watch remains unchanged at 6180/6160. Only a breakdown below 6160 exposes 6120, which is also very close to the lower limit of this medium term descending channel. Only a hourly close and a push up above 63.20 for today will invalidate today's intraday bearish bias to see the extension of the mean reversion rebound extending up towards the next near-term resistance level at 63.80 and potentially even 64.30, which is the minor swing high of 12th of December, and also confluence with the downward sloping 50-day moving average. So net overall, there could be some signs of bounce heading into the European session. First resistance level to watch 62.60, but we will be using this bounce as a sign to fit any potential strength, maintaining that intraday trend bearish bias on the Aussie dollar using 63 figures /63.20 as my short-term pivotal resistance. Okay, what's up next for the dollar yen? So the dollar yen, despite that any verbal intervention yesterday, market still remains resilient, taking into account of the rising 10-year US Treasury yield and as well as Trump's continuation of his hawkish trade policy that could ignite further inflationary pressure in the US economy. So the dollar yen continues to print out a series of higher low yesterday, what we could see over here, but still can't break above the first resistance level at 15835/15880. So I do not want to push it my short-term pivotal support to be so tight at 15665 level. Okay, so this still remains our first support level to watch. Still using the 155.95 as my 155.95 as my short-term pivotal support level. We also correspond to the rising 20-day moving average. So this will be my short-term pivotal support level to maintain my intraday bullish bias on the dollar yen. Above 158.80 exposes 159.45, and above it sees the major risk level of 160.30. So why this 160.30 is important is a 2-time Fibo extension level taken from the low of 3rd of December, and this 160.30, if you go back in time over here, this is all the minor congestion area of 27th of June and 8th of July previously was supported. Then thereafter we see a steep plunge from it. After this steep plunge, the dollar yen continues to trigger downwards from 11th of July all the way up to August, almost 1 month. So this trigger plunge down was this 160.30 level was actually a kind of a prior intervention level where the Ministry of Finance instructed BOJ to intervene to sell dollar and buy the yen at that point in time in July last year. So this is the risk level to watch. That means, i.e., if I were to be a bull, once it hit the 160.30 level, my bullish bias will be less convincing because of the risk of a intervention that may come from Bank of Japan as instructed by the Ministry of Finance in BOJ. So, but however, as instructed by the Ministry of Finance in Japan, pardon me. However, if price action starts to break down today below 155.95 for hourly close below it, then the intraday bullish bias for the dollar yen will be invalidated to see a squeeze down, exposing the next near-term support level at 154.30, which corresponds to the rising 50-day moving average. If 154.30 can't hold, it may dip down to the key medium-term pivotal support zone at 153.30/152.70, which will correspond to the 200-day moving average. So net, still using 155.95 as my short-term pivotal support to maintain that intraday bullish bias on the dollar yen. Key risk level to watch out for when the dollar yen float upwards will be the 160.30 level, where there could be some signs of intervention taking shape over here at 160.30. So that's for the outlook on the FX market. All right. So without further ado, now let us now focus on the intraday technical outlook on the major stock indices, starting with the Hang Seng Index or the Hong Kong 33. So the Hong Kong 33 continues to remain weak. We still maintain that intraday bearish bias yesterday. So right now it has clearly broken down below our first support level at 19,337 over here. Okay, taken down to right now over here. Okay, so with that, I will tidy up the short-term pivotal resistance for today, pushing it slightly higher. All right, taking into account of today's intraday high at 19,580. Okay, adjust the short-term pivotal resistance level since it has broken down below our first support level at 19,337. So using 19,580 as my adjusted short-term pivotal resistance for today, still maintaining that intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. Next near-term support level to watch 19,030. A breakdown below it exposes the next key support level 18,460, which also correspond to the 200-day moving average as well. All right, over here. However, if price action starts to shape a breakout and with an hourly close above 19,580, adjusted short-term pivotal resistance for today, that would invalidate today's intraday bearish bias on the Hong Kong 33 to see a squeeze up to retest 20,150 again. Above 20,150 sees 20,520 next, which correspond also to the former minor trend line support now turns into a pullback resistance at around 20,520. So net in a nutshell, still maintaining that intraday bearish bias on the Hong Kong 33 using an adjusted short-term pivotal resistance for today that will be at 19,580. Now, turning our attention will be the Japan 225 or the Nikkei 225. So the Japan 225 and Nikkei 225 continues to be trapped within this neutrality zone that we have for yesterday. So still no change, still maintaining a neutrality stance on the Japan 225 using 40,155/40,420. And that's the upper limit of the neutrality range, and the lower limit of the neutrality range will comes in at 39,180 next. So what's next for the German 30 and the German DAX? So the German 30 and German DAX yesterday float up, hesitance at the short-term pivotal resistance that we highlighted yesterday at 20,360. And what we could see yesterday is that yes, it print a higher high over here, this high higher than this high on the German 30 price action, but the RSI shows a divergence, which is a bearish divergence, and it has right at the overbought level, and right now it's really exited from the overbought level, indicating that yesterday's push up is momentum has starts to upside momentum has starts to be dissipated over here. So with that, we will flip to we will still maintain that intraday bearish bias using 20,360 as my short-term pivotal resistance level, but we are taking things slow this time around. The higher support level to watch on the intraday basis. First level to watch will be at 20,000 20,250 for today. Okay, a breakdown below it sees 20,120 next, and only a break below 20,120 may expose the psychological level of 20K, which is the former minor range resistance of 20th of December and 3rd of January, where it gives this bullish breakout, trigger this bullish breakout. Now turns to a pullback with key pullback, minor support level at 20,000, and so correspond to the minor ascending trend line from the low of 20th of December as well, that also confluence at 20,000. Okay, so only a hourly push up and a clear break above 20,360 will invalidate today's intraday bearish bias to see a squeeze up to test the all-time high area at 20,470. A breakout above it sees the next resistance coming in at 20,650, which corresponds to the upper limit of this major ascending channel as well. So net in a nutshell, still maintaining that intraday bearish bias on the German 30, using 20,360 as my short-term pivotal resistance for today. And for today, we do have higher support level to watch, which is 20,250, followed by 20,120 on the German 30. Now, turning our attention will be the major US stock indices, the US Wall Street 30. Yesterday, we maintained that bearish bias. Price action exactly hit the first support level before staging a bounce during the close of the US session. All right, and into Asia session, it also starts to trade in this level, this certain level as well. So since it can't break below the first support level at 42,490, we do not want to tighten our short-term pivotal resistance zone to be so tight at 42,960. So we still maintain it at 43,160 / 43,350, which also confluence with the downward sloping 20-day moving average as well. So as long as 43,160, 43,350 short-term pivotal resistance zone holds, we'll still maintain that intraday bearish bias on the US Wall Street 30. Below 42,490 sees 42,210 next on the intraday basis. However, if price action starts to shape a push up above 43,350 with hourly close above it, then potentially we may start to see a recovery scenario coming into the US Wall Street 30, i.e. the Dow Jones Industrial Average, seeking out the next near-term resistance level at 43,720, followed by 43,960 next. So i.e. in a nutshell, still maintain that intraday bearish bias on the US Wall Street 30, using 43,160 / 43,350 as my short-term pivotal resistance zone. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100, yesterday we do have a neutrality stance. So neutral between this 21,730 and 21,350. So price action very clearly taken out, has an hourly close below 21,350, validating a further intraday bearish bias on the Nasdaq 100. So first, because now it's already at the oversold level, so there could be some signs of a minor bounce taking shape. So this minor bounce may bounce up towards 21,350 during the European session. Above it, it may float up towards this area here, 21,400 level, but using the 20-day moving average at 21,530 level. So this 21,530 level graphically is the former minor swing low of 7th of June and 7th of January. No, pardon me, 7th of January now turns into a pullback resistance level as well. And if you do the Fibo retracement, that corresponds to the 76.4% level. So we will use this oversold condition to fade any rebound that may take shape during the European session, but flip to a intraday bearish bias as it comes close towards the 21,530 short-term pivotal resistance level on the Nasdaq 100. First support level to watch will be close to the 50-day moving average at 21,040. A breakdown below 21,040 exposes the this minor range support level that has been in place since 20th of December at 21,860 / 21,780. Only an hourly close above 21,530 will invalidate today's intraday bearish bias to see a squeeze up towards 21,730 and even 21,890, which is the minor swing high of 26th of December and 27th of December last year. So i.e. in a nutshell, using any potential strength any bounce later during the European session to fade any rebound and flip to a intraday bearish bias using 21,530 as my short-term pivotal resistance on the Nasdaq 100. Okay, now turning our attention now to will be okay. That also sum up the intraday technical outlook on the major stock indices. Now let us focus now on the commodities market, starting with the gold XAU/USD. So for gold XAU/USD coins to trade sideways. So I did mention that since the low of 14th of November, gold has been potentially trading in this minor ascending triangle range configuration. All right, over here, it can break the upper limit of the ascending triangle range configuration will be at 2007.16, 2007.28. And yesterday price action can't have a proper breakout above the downward sloping 50-day moving average. So still no change. There was a bearish reaction right exactly at the short-term pivotal resistance zone that we highlighted yesterday, 2664/2674. So this resistance zone for sure will be very important to maintain that intraday bearish bias for it to float down towards the lower limit of this ascending triangle range configuration at 2614/2006 figure level. All right. However, if price action starts to shape an hourly push up with a close above 2674 short-term pivotal resistance zone, that would invalidate today's intraday bearish bias within its range scenario to see it floating up towards the upper limit of this minor ascending triangle range. First resistance level to watch 2690. Above it sees the upper limit of the range resistance at upper limit of that ascending triangle at 2716/200728. Lastly will be the West Texas crude oil. So for West Texas crude oil, what I could see over here is that yesterday it hit our almost hit our first support level. Oops. Yesterday, it almost hit our first support level at 73 before staging a bounce. And what we could see is that the RSI, the hourly RSI continues to print out a series of lower high, all right, indicating the lack of upside momentum still persists. So with that, no change. The short-term pivotal resistance zone to watch out for today will be 7530//7580, which will correspond to the 200-day moving average. First support level to watch out for today, I will put it a slightly higher one. Okay, at this 73.80, only a breakdown below 73.80 exposes against 73 figure level, and below 73 figure level will see much further weakness towards 72 figure level support next. However, if price action starts to inch up higher and break above 75.80 upper limit of this short-term pivotal resistance zone, then that would invalidate today's intraday bearish bias to see a squeeze up to test the major descending channel upper limit, acting as a resistance at 7670/77 figure on West Texas crude oil. So i.e. in a nutshell, still using 7530/7580 short-term pivotal resistance zone to maintain that intraday bearish bias on the West Texas crude oil. So that also sum up the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar to see what are the key data to look out for today. So during the European session will be rather quiet. We do have at 6 p.m. Economic sentiment data for December out at 6 p.m. in Eurozone that could impact the euro, dollar, and potentially even the DAX as well. And into the US session over here, we do have a tier 2 employment data. We call it the ADP employment change data that is out at 9:15 p.m. before the start of the US cash stock market session. And also at 9:30 p.m. we do have one Federal Reserve official speaking, Fed Waller speaking. And going to the later part of the US session, the weekly EIA crude oil stockpile change, 11:30 p.m. that could also potentially impact the movement of the WTI crude oil price. And thereafter will be, yeah, so this sum up the calendar for today, and as well as today's daily dose of market insights. So I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.